All right, let's dive right in. Today, we're talking about a trading concept called time series momentum. Now, on paper, this thing looks like a home run. It really does. But as you can see from the title, this is a bit of a cautionary tale, especially when people get greedy and try to speed things up.
And look, before we go any further, we have to get this out of the way. This is super important. What we're breaking down here is for educational purposes only. This is not investment advice. We're just exploring the mechanics of a strategy, not telling you how to trade in the real world. Please keep that in mind.
So what even is time series momentum, or TSM for short? Well, the core idea is actually beautiful in its simplicity. You're just looking at what an asset has done in its own recent past. Is it going up? You're in. Is it going down? You're out. That's it. You're basically just riding the wave.
And that right there brings us to the big question. This simple rule, it seems so powerful. But what happens when you take it and apply it to really high-risk, leveraged products, and then you try to trade not just every day, but every hour? Well, that's where things get interesting. Let's find out.
Okay, so first things first, let's lay out the groundwork. We're going to look at how a standard daily version of this strategy is supposed to work, in theory. This is the version that looks so good when you see it on a spreadsheet. The rules couldn't be clearer. We're using a 50-day simple moving average. That's just a fancy way of saying we're taking the average closing price over the last 50 days to get a smooth trend line. Now, if the price closes above that line at the end of the day, that's your signal. You're in. If it closes below it, you're out. You sell, and you wait in cash. Simple, right? In or out. And here you can see exactly what I'm talking about. See how the price, these candlesticks, they weave above and below that smooth blue line? That's our moving average. Every time the price pops above it, boom, that's a buy signal. And every time it drops below, that's your signal to get out. It's a really clean, simple way to follow a trend.
All right, we've got the rules down. So why does anyone even care about this strategy? Well, now we get to the fun part. Let's look at some hypothetical numbers that show just how powerful and appealing this daily approach can look.
Now, check this out. The difference in performance here is pretty dramatic. In this hypothetical test, if you started with 10 grand, the TSM strategy turns it into about $36,000. A simple buy and hold approach, just $20,000. That's a huge gap in the annual growth rate. But honestly, that's not even the most important number on this slide. This is the one, the maximum drawdown. This tells you the biggest hit your account took from its highest point. With the TSM strategy, you were only down about 15% at your worst. But with buy and hold, you had to stomach a crushing 55% loss. And that is the main appeal of trend following. It aims to get you out of the market before those catastrophic drops happen. But, and this is a huge but, we have to remember these are perfect world, theoretical numbers. They don't include all the messy real-world stuff like transaction costs. So far, this has all been theory. Okay, now let's pivot to reality. And here's the turn. This is where our story really begins. We've seen how attractive this all looks on a daily chart. Now we're going to walk right into the trap that's waiting for traders who think faster is always better. I mean, it's a totally natural question to ask, isn't it? If following the trend once a day is good, then following it every hour must be fantastic, right? More signals, more chances to profit, it just seems logical. But this is exactly where the beautiful theory starts to fall apart. So why is faster so often a trap? Well, it comes down to three main villains. First, you have a whipsaws. The price just bounces back and forth across the line, triggering tons of false signals, and you die a death by 1,000 cuts. Second, there's compounding decay, which is a nasty little feature of leveraged products. And third, the big one, transaction costs. Every single one of those trades costs you money. Okay, so let's stop talking theory. Let's look at the cold, hard data. This is where we see a once promising idea completely break down as you crank up the speed. And the numbers here are just stark. That incredible 260% return we saw with the daily strategy, it collapses. It's down to just 100% on a 1-hour time frame. And look what happens to the risk. That max drawdown gets way worse, jumping from 15% all the way to 30%. Think about that. You are getting way less return for way more risk. It's the exact opposite of what you want. And why? Well, a huge part of the answer is this number right here. With a 1-hour strategy, you could be making around 1,500 trades a year. Compare that to maybe, 100 on the daily system?
Every single one of those 1,500 trades has a cost. Commissions, the spread, and that friction just grinds any potential profit into dust.
This chart just makes the story painfully clear. You can literally see the performance decaying right in front of you. That awesome 38% annual growth from the daily strategy, it gets chopped down and chopped down again the faster you trade. The trend is obvious, and it is absolutely going in the wrong direction.
So, after all that, what have we learned? It's time to bring it all home and boil this down to the core lesson, the painful gap between a perfect theory and a very messy reality.
If you only remember one thing from this whole explainer, let it be this. Transaction costs are not a small detail you figure out later. They are the single biggest risk that can take a strategy that looks like a genius idea on paper and turn it into an absolute money loser in the real world. And that really leaves us with one final thought. This isn't just a story about time series momentum. It's a bigger lesson. The next time you see a backtest showing some unbelievable returns, the first question you should ask is, what real-world costs are they conveniently ignoring? Because sometimes that's the only thing separating a great theory from a very expensive reality.